Welcome to Speaking of Settlements. I'm Scott Drake. Today my guest is Mark Wallstrom, the president of Wallstrom & Associates in Scottsdale, Arizona. Mark, welcome back.
Thank you, Scott. Glad I could make it in.
So big news today. Hartford Financial Services has announced that they're putting their annuity and life insurance units into runoff. What does this mean, Mark, for the annuity business?
Well, Scott, this is something, not that it came out of the blue. I mean, we could see there were some things stirring. Hartford has had a difficult 3 or 4 year period. At one point, they were one of the originators of the variable annuity product. They were one of the major sellers of variable annuities. They were a dominant presence in structured settlement and other fixed annuity and pension products. But in 2008, they really ran into some problems along with some other companies. They were one of the life markets that did have to accept TARP funds. And there was a period of time where they, not that they shut down, but like their structured settlement division was essentially closed for a couple of years. There were concerns about their credit rating. And they seemed to have weathered that and weathered it quite well. But there had been some people who were very restless, some major shareholders that were very restless, not happy about the fact that the company was trading at 50% of its book value. And there was an analyst conference call in February at which one of the major shareholders essentially threw down the gauntlet and told them something had to be done about the share price. So today's action is, I think it's more isolated and related to Hartford than it is a systemic problem or issue in the annuity business.
Can you explain what it means when a company puts its life or annuity company into runoff?
Well, Scott, runoff is an insurance company term whereby they simply stop taking new business. It shouldn't be a term that causes annuity holders or contract holders or those who have structured settlements with Hartford, they should not be concerned. It's an industry term that simply means they're not going to take any new business, but that they're going to maintain the existing book of business, the existing contracts, pay benefits as promised on schedule, and run the company off. The people who are most impacted are agents, people who work in marketing, sales, new business, things of that nature. But they will keep a staff in place, typically historically. And also it's important to note that runoff is something that has to be approved by a state insurance department. The insurance commissioner and the insurance department in Connecticut will watch this situation very closely. They have to follow a lot of rules which are geared toward policyholder protection. So I wouldn't have people get overly concerned about that term, but that's what runoff means.
So do you think then this is a prelude to the sale of the units? Because didn't they try to sell these companies last year or the year before and there weren't any takers?
Well, Scott, I think you hit the nail on the head. I mean, they have tried to sell the life and annuity business and their broker-dealer business and tried to find buyers multiple times over the last 3 years, or at least that's the rumor, that's the news that was in the financial and insurance industry press. The fact that they couldn't was an indication, I think, of the low profitability of these units based on the way the contracts were written, the policy provisions. A big part of it was on the variable annuity side and the annuity side. These were generous contracts. They were very annuity holder or contract holder friendly contracts. And when the market fluctuated and there were a lot of different issues that came up in 2008, 2009, it has made it so it's not an attractive book of business, apparently. Yes, do I think they're going to try and sell it? Absolutely. The press today said that Goldman Sachs had been engaged to look into the possibility of finding a buyer for the units. So I wouldn't be surprised if they do. But they've tried it before and without success. And I think they've just essentially said, let's stop pretending that we're going to be in the business of accepting new business. Let's put these in runoff. Let's take the hit now. And let's concentrate on our core business, which is property casualty, which is a very robust, profitable business for the Hartford, and is probably the right business decision based upon the numbers and finances that we've run into and viewed with that company over the last 3 years.
Now, Mark, who is John Paulson and why does he have such an impact on Hartford, and what did he do to spur this on?
Well, Scott, John Paulson is a hedge fund manager. It's Paulson and Company, I believe is the name. Major hedge fund manager. He owns reportedly more than 9% of the Hartford, is a major shareholder, and he was extremely unhappy with the share price. As I mentioned before, it was selling at 50% of book value, which is extremely low. The stock had declined 15% over the last year. And in a conference call in February, he voiced his displeasure that management needed to do something. Well, now, Hartford's management today is saying that they didn't take this action because of Paulson. His decision really behind the scenes apparently to push this sale and push this action has caused management to act. And the fact is, when you have a major shareholder with that kind of power, they have to listen to him. Despite their protestations that this was a move that had been in the work for over a year. It probably had, but I think he had accelerated the decision process to where we reached the point that we're at today.
So, Mark, Standard & Poor's immediately downgraded the Hartford Life and Annuity Company's ratings to A+ for the life unit and B+ for the annuity company. Should policyholders be concerned about this?
Well, Scott, a downgrade from Standard & Poor's of a life unit, it typically doesn't happen this quickly. Although in this instance, I think they're concerned because people don't know what the final ownership structure will be of those units, if somebody's going to come in and buy them, who that buyer might be, what sort of pledge or guarantee that Hartford Financial Services would have in runoff to guarantee these additional units. So the fact that there is going to be, or potentially could be, some decoupling between Hartford and these units certainly raised some concerns with Standard & Poor's. The impact to policyholders should be negligible to, next to negligible. BBB+ is still an adequate rating. The problem would be in the new business side and the new sales side. Most agents, myself included, are not allowed to sell companies that are not rated at least A- under E&O contracts or sales agreements that they have with various clients. So it would have effectively ended the sale of a lot of product as a result of these changes. But again, I don't think the impact for policyholders is going to be that significant.
Well, finally then, what is the impact on the structured settlement profession to have another market exit, and what does this say about the annuity business when, by all indications, many companies right now are having record years at the sale of fixed traditional annuity products?
Well, Scott, it brings up the point again that we discussed before, which is that I think the Hartford case is relatively unique. They had a large book of variable business that was expensive, had contractual provisions that they could not rid themselves of, and has continued to be a drag on that portfolio and on that business. They've not been able to really restart sales because of the concerns, and I think really they've strategically done the proper thing. Obviously, from the structured settlement side, Hartford came back into the business about 6-7 months ago. Now to have them exit again, I'd prefer that they stayed in. I think a lot of people would have, but it's a business decision, and the fact is that most of the companies that are in the fixed annuity, indexed annuity, let's call it the traditional annuity business, are having very good years, on both their structured and non-structured sales. People are looking for security. The product is sound, but it focuses in on the fact that you have to have a company that understands and is comfortable with the cost of being in the annuity business. It's expensive business to write for insurance companies. It's what's called reserve heavy or reserve expensive business. So strategically, it's not for every company to be in, but it is good business for those who are in it, understand it, and manage it well. So while the loss of the market, for structured settlement agents is a problem, and certainly we'll have some concerned customers and clients contacting us, it's really kind of a bump in the road, and you feel more for the people working at Hartford that may lose their jobs as a result of this, and the rest of us will pick up and move on.
All right, Mark, thank you so much.
Thanks, Scott. My pleasure. I look forward to talking to you again soon.
Watch for more on this story. I'm Scott Drake, and you're watching Speaking of Settlements here on the Legal Broadcast Network.